Hello, everyone. It's Sunday in New York, October 19, 2025. I was having technical difficulties. Basically, I forgot to turn on the mic, so I was talking for like 10 minutes, but that my voice didn't get recorded. So let's do this again, right? Okay. Today's topic is on a friend of mine asked, should he invest in US market? And my answer would be always be yes. You always want to fully invest, okay, in the number one economy of the world, and currently that's US. And you invest in the you would invest in an index fund that represent its economy. Basically, what you're capturing is the economic growth of the country, of the GDP, or for all the company, all the businesses, and that's what you're capturing. And that's no better way to capture long-term return, I would tell you. Okay. Um, so yes, now, but the question you got to ask yourself is, okay, so I'm investing in this. The answer is yes. Then it becomes when and how, right? Well, first, let's address pullbacks and drawdowns, okay? How often you will have to experience your pullback and drawdowns, and that gives you put you in perspective of your how long your time horizon, right? I always ask actually versus how long is your term horizon. Then I will explain the potential pullbacks and drawdown you may experience within your investment lifespan. Okay. So looking at this slide is very simple. And this is something I just Google and ask ChatGPT, and it will tell you right away. Love AI, right? Utilize it, use it, let it help. Okay. A 5% is about once a year drawdown, right? 5% drawdown. A 10% or more drawdown once every 30 months. 15% drawdown once every 5 years. 20% drawdown once every 6 years. Okay, now you have that. So if my short term actually, when I am investing, my short term time horizon is actually, to me, is actually 3 years. Is that short for me? Okay, so because look at this way, a 20% drawdown, although it happens on the average about once every 6 years, doesn't mean it's not going to be tomorrow. Okay, all right, it could be, and it doesn't mean it will not occurs back to back into from 20% into 40% or so, right? So you have to be able to withstand. You have to be able to withstand these type of drawdowns, and simple as that. So here's the thing: when you reach a 20% drawdown, the takeaway is this: the bottom line is 20% or more decline lasts an average of 370 days. Okay, a year. Okay, you have to be able to hold it not only for the years, at least for a year, okay, and you have to hold it through subsequently for it to comes back, break even, and then make you more money, okay. And in actuality, that will take around 36 months. So if you happen to buy today and tomorrow it goes into a 20% drawdown, now you're going to hold it for 3-4 years, right, for it to come back. Otherwise, you're going to have to take a loss, right. Okay. So all about your time horizon in actuality. And if you have a very short time horizon, then a long term US index holding might not be the best approach. Uh, of course, the other approach is actually even more risky, but it's a lot more active in that sense. But this is a very passive, you buy and hold, right, in that sense. Okay. So now we address the potential drawdown period. And so the next question is, okay, so now I know the drawdown. When do I buy in? We have a nice run for the last 2-3 years, right, on back of AI, basically. Okay, so as you look, right, from back all the way, right, the last bottoming, right, this is actually like triple bottom. Okay, it was back in December 22 or so. Okay, so that's wow, that's 3 years or so, right? No, right? So are you buying the high if you buy in today right now? The question is. Right? Well, let's put it this way. Let me put it this way with perspective. Let's pull all the way back 10 years ago, 2015. If you bought in there, the QQQ was only $100, okay? 10 years ago. Now it's 6.4, right? So here's your answer. So I would say, as long as US is number one economy of the world, just keep buying and keep holding. Matter of fact, you should have been buying every dip. Which dip? I would have buy every dip on the 200 days moving average. Right? The institutions look at this 200 days moving average closely because that represents more like year of trading of basically is the market in the bear mode or is the market in the bull mode? Right now, we've been having such a nice bull market. Right? Once they're above this 200 days moving average, I use the green shade area. Instead of a line, I use a green shade area. So to give you a very clear picture, am I above, is the market above or is the market below this 200 days moving average? So just looking at this nice rally for the last 2-3 years, you should have bought every time it touch and bounced off. You see how it touch and bounced off, touch and bounced off? Well, this is the April tariff this year. Okay. It went below the 200 days moving average, and then eventually people were like, oh, no. And they bought it all the way back again, right? So sometimes you experience this situation, not necessarily always bounced off, but the previous two drops, it did bounce off. So right now, yes. Right now, the 200 days moving average is at around $540. And that is actually coincide with the previous peak, okay? Big meaningful peak right before the tariff dropped of April of this year, okay? You have this double top, and then it drop, and then come back, and then when it break, that's a breakout play, actually, okay? But let's stay with this, okay? So you have two technical points, really good support area. So that will be like, oh, right now it's around 600. If you move back, drop a 60 point, that will be a nice discount to buy in. Okay, so right now, do I buy right now or do I wait for the drop? Well, I cannot tell you when it will drop, but right now it's like really on the high peak of things. I even draw a line, a trend line connecting all the peak, and it's just right here again, right? We have this line, and if I extend it, again, peak here, previous peak here, right? And that connect all these peaks even before the rally, right? So connect the point. So this is at a high again. I have a little reservation if I'm going to deploy a lot of capital right here, right now. I will wait for a nice pullback. That will be ideal. Well, here's the thing. I get paid to wait. Okay, I use option strategies to get paid to wait. And how do I do that? Okay. Is that I will go to the options screen and look at around 45 days to expiration, option. Okay. Option has three pieces: the time, duration to expiration, okay, the strike, and the underlying price. Okay. So right now, I'm looking at a 40 days left, November 28, 2025, put options. I'm going to sell put options, basically. Okay. First, I select the date, duration, 45 days or less. Okay, I don't want to 60 days. That's too long a wait. 30 days is too short. This is ideally it's actually 45 days to collect this premium. This is the richest in premium. We select around 45 days in actuality. Okay. So next, I select the strike price. Okay, and right away, I'm thinking, okay, 540 is a good place to buy. So let's look at the 540s strike. Well, guess what? The 540 strike, people will pay me $379 to sell them this right, okay? That they can sell me stock, 100 shares of QQQ at 540 $540 each share. I'm willing to buy 100 shares at 540 shares if the instrument QQQ went below $540 at the day of expiration. The other second piece, very important piece of information, is called the delta. I'm looking at 540 and delta is 12. Delta, in plain English term, what it tells me actually is my probability of winning or losing. Yeah, sure. Okay. A quick way to look at this. So I have a 90% win rate. That means basically 10% probability this option on day of expiration, November 28th, will be at strike price below $540 or at $540. Okay. So I will have to buy 100 shares because I'm willing to put the money and sell the puts. But what I gain is $379. But that's a little too little because I think, okay, so I will move this up. I will move the strike price. Let's look at the 560. Well, now become 19 delta. Right. So around 80%, 83%, right? Now I will pocket $600, much better numbers, right? So you have to find a number. Are you willing to buy at 560? Okay, if that does happen, that it dropped down to that strike price 560 a day of expiration, you're gonna have to buy 100 shares 560. Matter of fact, it will probably go through and then continue you could go lower basically. Okay, and you will be buying at a higher price. Keep that in mind. But as a long-term holding in your portfolio, eventually give it enough time. Okay, give the greater market at work, U.S. economy at work. It will eventually not only come back and make new highs. Okay, that's just the nature of the number one economy of the world. It's like capital just flow there. So a 540 is only $379 versus the 560 is at 588. So yeah, I might do that. I'm willing to wait, lock in my capital, okay, and wait 40 days. In the meantime, I'm collecting around $600 to wait. That's great. And not only that, is that I'm waiting for it to come to a lower price. I'm willing to buy the instrument. So this is how I will add to portfolio when things at the peak. Matter of fact, I will wait for the market to actually start pulling back. Then the premium will get richer, or I move to a lower strike price in that sense. But the idea is the same. The principles are the same. Okay? Use option to buy in when things are a little too far away from the price you want to pay. And over time, this is how you kind of like collecting rent and getting paid to wait. You want to own the asset. It's not the price you want. Well, you can already start making money of it. That's the beauty of this. And that's how it works. And it's wonderful. It worked great over the years. Especially if you have a long-term investment horizon on instruments that have a natural positive progression over time. That means you have an uptrend over time. If you look at this at the last 100 years, yeah, it's a nice uptrend. Matter of fact, I always tell people, if 25 years ago you bought in QQQ, during the internet bubble, okay, even at the worst price, okay, if you put in $100,000, it will be around 1.3 to 1.8 millions today, right, for only $100,000. So there you have it, 25 years, 100,000 to 1.3 million. Imagine what this can do for you. And we're on back of major technological investment and revolutions. Right? The 80s, you have the PC market, well, and nice market run, right? Yeah, you eventually pull back. And then the year 2000, internet, right? Of course, eventually burst, but eventually come back, and then you have the real estate market. Yes, that has subprime burst, and come back. Imagine you bought all those low. Wow. Okay. Right? This is why the wealthy will always get more wealthy, because hey, people buy it, they have the staying power. Okay, that's what you need. Have the long view and give yourself the time horizon to let things work out in itself. This is just human nature that we want to expand, we want to make profit, right, in capitalism. And being number one economy in the world, well, until we're not number one, I have no doubt. Okay, I have no doubt. So there you go. This is how I will use option to play and how to add to my portfolio. Very straightforward. Look into this strategy called cash secure put. And that's is exactly how I add to my portfolios. And that's all today. Thanks for watching.